Hey guys, welcome to the play-by-play stock option basics trading course. On this video, I'm going to answer the question, what are stock option contracts? All right, and let's get straight into it. So first things first, just need to understand that one options contract is equal to 100 shares of the underlying security, okay? One contract is equal to 100 shares of the underlying security. So anytime you get 2, 3, 4, 5, you are multiplying that by 100 shares of the underlying security to help you understand how much money you are going to be using to place your trades, okay? So one contract is equal to 100 shares. Just understand that. And then we'll continue and we'll cover more in-depth details on how the execution of options trades are performed, whether you're doing singles, spreads, or naked trades, okay? So let's just go into the nitty-gritty here and just go over the definition. You have two kinds of options. You have call options and you have put options. A call option is an options contract that gives the holder the right, okay? It gives you the right to buy the underlying security at a specified price for a certain fixed period of time. And then a put option is an options contract that gives the holder the right to sell the underlying security at a specified price for a certain period of time, okay? So one gives you the right to buy, the other gives you the right to sell, okay? So you just keep in mind that this is only taken into consideration when you are the buyer, okay? Not the seller. So if somebody's selling you the contract, there's another side to the story. So you can be the buyer or you can be the seller. And so if you have the right to buy when you are the buyer, just understand that when you're the seller, you have the obligation to sell. And vice versa, you have the obligation to buy when you are the seller on the put side, okay? So let's go ahead and take a look at an options chain here so that you can see what this looks like. So when you're trading equities, you may be used to just trading off of the active trader, the trade matrix, or even straight from the chart. When you're trading options, you'll be trading from the options chain. And this is what an options chain looks like. What you have here on the left, you'll see all the different expiration dates that are available for you to trade from. Okay, so the expiration here tells you how many days are left for you to be able to execute these trades, okay? So on the left, you have the expiration, and then you can expand these or expand the number of strikes that you see. What is a strike? The strike is the agreed upon price that we mentioned earlier, okay? So you have a specified price for a certain period of time, okay? So what is that specified price? You have specified price. So you have specified price are your strikes. Fixed period of time is your expiration date. Okay, so specified price are your strike prices, which are the different prices that the stock can be worth at the time of expiration. Okay, so we have 4 days. Amazon right now is at 1913. Bid is between 1911 and 1914. Okay, bid and ask are 1911 and 1914. Current or last was 1913, which is the value. At the time of expiration, which is 4 days from now, you are agreeing that you are either going to buy and or sell if the stock at a specified price. Should you choose to exercise your right by the time of expiration, okay? And that's all a call option and a put option are, okay? It's a contract for you, giving you the right to buy and or sell a specified underlying instrument. In this case, we're taking a look at Amazon, at a specific price by a specific date, okay? And then you have two kinds of options. You have your calls on the left and your puts on the right. Just about every platform, you're going to see it on this manner. So that's it for this video, guys. I hope you understood the basics of what a put and a call option are. Basically, the calls give you the right to buy when you're the buyer, and the puts give you the right to sell, again, when you're the buyer. Just know that you have the obligation to do the exact opposite when you are the seller, okay? So if you sold a call option and you are assigned, meaning the other party exercised their right, you have the obligation to sell. And in this case, you have the obligation to buy. And we'll go into more detail in the videos to come. On the next video, we're going to cover the difference between in the money, at the money, and out of the money options. I'll see you guys in the next one.